Most traders don't lose money because they're stupid. They lose money because the market is designed to trick them. Every single day, the market sets a trap so clean, so convincing, that thousands of traders walk straight into it without even realizing what just happened. One candle, one breakout, and suddenly their stop loss is gone. If you've ever entered a perfect breakout, felt confident for a few minutes, and then watched the market reverse and kick you out, this video is for you. Because today I'm going to show you how these traps are created, how smart money uses them to steal liquidity, and how you can learn to spot the trap before it snaps shut. So, stay with me till the end, because once you see this, you'll never look at breakouts the same way again.
Disclaimer: this video is for educational and informational purposes only. I am not a financial advisor, and nothing in this video should be considered financial, investment, or trading advice. The stock market involves risk, and losses can exceed your initial investment. Always do your own research and consult with a qualified financial professional before making any trading or investment decisions. You are fully responsible for your own trades and outcomes.
Hey everyone, listen up. Most people who jump into the stock market end up losing a ton of money, sometimes everything they put in. It's brutal out there. But there's a small group of traders who actually see the game for what it is and end up making serious cash. Today, I'm going to break down one of the biggest pitfalls in the market in plain English so you can spot it, avoid getting wrecked, and maybe even flip it to your advantage. Almost every single day, you'll see this play out. Price hits a key resistance level, and retail traders like you and me pile in long, slapping a stop loss just below. The market teases you. It creeps a little higher, you're feeling good. And then, out of nowhere, it reverses hard, drops back down, and wipes out your stop. Boom, you're out. Account lighter, frustration through the roof. That's the classic market trap, often called a bull trap or trap trading. It's also known as a false breakout.
Picture this on a chart. There's a strong resistance zone that's held price back multiple times. Suddenly, it breaks above it and closes higher. Retail traders see that breakout candle and jump in, thinking the move is on. But then price snaps back below the level, stops everyone out, and keeps falling. That trap was deliberately set by the big players, what we call smart money, institutions, hedge funds, the whales who move billions at a time. These big players have one main goal: push price right up to that resistance, force the breakout, and trigger all the retail buy orders and stop losses below. Trading is a zero-sum game. Every dollar someone loses goes straight into someone else's pocket. To scoop up retail money and keep us from riding the real moves, the institutions take massive positions on the opposite side. When they win, the market swings their way, and all that retail capital flows right to them. Traders who throw on tight stops without thinking get eaten alive every time. But if you start thinking like the smart money, you can spot these traps early and even profit from them. So how do you actually identify these traps and fake breakouts on your charts? The single most important thing to watch is volume. Price can lie or fake you out, but volume tells the truth. It shows whether big money is really behind a move or not. When you're trading in this ocean, you want to swim with the sharks, not against them. Ignoring volume and trading purely off price action is a fast way to keep getting burned. If you're not sure how to add volume to your chart, it's easy. Just pull up your indicators and select the volume bars. They'll show up as green and red bars at the bottom. Taller bars mean higher volume. Trading index options like SPX or NDX pay more attention to open interest instead of volume, but the concept is similar. Here's how to read it for real versus fake breakouts. Let's say price is grinding higher on a series of green candles. It pulls back a bit with small red candles. That's normal. Check the volume during the advance. If the bars were getting taller as price rose, that's strong buying pressure. During the pullback, if the volume bars shrink compared to the up move, it means selling pressure is weak. Buyers are still in control. Then, when price finally punches through the recent swing high with a strong green candle and closes above resistance, Look at that breakout bar's volume. If it's significantly taller than the pullback bars, you've got confirmation of real buying conviction. That's a high probability long setup. Jump in with solid risk reward and let it run. It won't win 100% of the time, but this filter catches a lot of winners. Now flip it for a fake breakout. Price breaks resistance and closes slightly above it. But check the volume on that breakout bar. If it's already pretty big, okay, note it.
Price starts pulling back on increasing volume, taller red bars. That's a warning. Sellers are stepping in aggressively. If price tries to recover with small green candles, but on shrinking volume compared to the downside bars, buyers are losing steam. Mark the recent swing low. Once price breaks and closes below that low on expanding volume, taller than the weak recovery bars, that's your confirmation the breakout failed. Close any longs immediately and flip to a short position with good risk reward. That's how you turn the trap against the trappers. Another common example, price is ranging sideways in a tight zone. A candle finally breaks the top of the range and closes above it. Newer traders see that and go long right away. But then price drops back into the range and triggers all the stops below. It bounces near the bottom support. Traders buy the dip hoping for reversal, but it closes below support and stops them out again.
Double whammy. Psychology wrecked. Fear sets in, and they miss the real moves later. Look at the same setup with volume. That initial upside break happened on low or average volume. No big bar. Smart move is to stay out and wait. When price later breaks the bottom of the range and closes lower on a massive red volume bar, that's conviction selling. You get short there, manage risk properly, and ride a nice downside move. 3 big takeaways from that. First, have patience. Wait for the right setup instead of forcing trades. Second, always wait for the candle to close before entering. Never jump the gun. Third, never ignore volume. It's your best friend for filtering out noise. Not every breakout fails, of course, but knowing where fake ones are more likely helps a ton. Here are some key levels where traps show up frequently. Mark them on your charts. Previous days high and low, if price blows straight through without any pause or consolidation, it's often a trap. Current days developing high and low, same thing. Direct breaks without hesitation raise red flags. Round psychological numbers like 5,000, 5,100, or whatever big even level the market's approaching. These act like magnets for retail orders, and smart money loves trapping around them. At all these spots, think carefully and try to view the chart from the institution's perspective. If you want to stay profitable long-term, you have to avoid chasing every breakout and develop the patience to sidestep the obvious traps. A few rules of thumb for timing entries in a trap-filled market. If price blasts through a key level with no prior consolidation or time spent testing it, odds favor a fake out. Either sit it out or trade the failure in the opposite direction. If price hangs out and consolidates right at or below the level before breaking higher, that's usually real strength. Take the breakout trade. After the break, watch behavior. If price comes right back and starts consolidating above the level instead of continuing higher, the breakout is likely failing. Wait for confirmation, then trade the reversal. These 3 filters will sharpen your breakout game big time. Finally, a couple quick tips that will save you a lot of pain. If you're newer to this, keep your position size small and reasonable. Big lots feel great on winners, but one bad trade can wipe you out. Patience is everything. Without it, you'll enter too early or exit too soon. Focus on 1 or 2 high-quality setups per day, nothing more. That's it for today. Hope this helps you navigate the markets a little smarter and keep more of your money where it belongs, in your account.
Of the day, the market isn't random. It's a game of patience, psychology, and timing. Breakouts aren't the enemy, but chasing them blindly is. When you slow down, wait for confirmation, and let volume tell you the real story, you stop being the liquidity and start thinking like the smart money. Remember, profitable trading isn't about trading more, it's about trading better. If this video helped you see the market more clearly, make sure you subscribe to One Market, One Story, because here we focus on real concepts, real market behavior, and smart trading, not hype. Stay disciplined, stay patient, and I'll see you in the next video.